Good evening, everybody. Thanking you for joining us here today on this new edition of the Market Insight Equity. Through some facets of the market in which we'll discuss earnings, we'll discuss valuations, we'll discuss some of the macro. And I'm delighted to have with me today on this webinar my colleague Srivatsa, who's the fund manager of our core equity fund and also the hybrid equity fund. And he will be talking in particular about the strategies that he runs. So that's the format that we've been adopting in recent months, which is to have an overview of what's happening in the markets and combine it with a fund or a strategy specific view by getting the appropriate fund manager. And as always, I have my colleague from the product team, which is Niranjan on this call, and he'll be sharing the presentation that we'll be using as a guide for today's conversation. So without any further ado, I'll just request my colleague Niranjan to bring the presentation up on the screen. Yeah, so hopefully that's now visible. So we'll just get underway. So, I thought it's very interesting, and maybe this is something that we can start with, which is the prices of global commodities. Now, most of you would remember that when we did this call in March, we spent a lot of time talking about what had happened due to the Russia-Ukraine conflict. There had been a sharp spike up in commodity prices. If you look at the Bloomberg Commodity Index on the left-hand side, you'll be able to see that, which is, in late February, March, you have this big spike in prices, which was a function of what happened in Russia and Ukraine. And of course, prices continued to, climb higher all the way till actually late May and early part of June. And this was a result of the supply disruptions which had happened across the board in commodities, be it energy, be it agriculture, as well as the metals complex. But fast forward to today, and things have changed very dramatically. If you look at the slides on the right-hand side, they show you the Bloomberg Industrials Metal Index. You can see over there the sharp spike which happened in Feb-March. But in fact, after that, the index has collapsed very sharply, so much so that it is now negative year to date from a starting point of 100. It's down about 14%, down to 86. The Bloomberg Agriculture Index is the next one on the right. And you can see that as well had a very sharp spike. It's still up year to date about 12%, but significantly off the highs that we saw in late April, early May. And finally, at the bottom, we have the Bloomberg Energy Index, which includes crude oil as well as coal. And you can see over there, this was the index which had the most dramatic move as a result of the conflict in Russia-Ukraine. As you know, Russia is the third largest producer of oil in the world, and due to concerns over the availability of oil, the energy index spiked higher, almost doubling. This has actually been the index which has still cooled off the least. But compared to being up 100% at the highest point in May, June, this index is now up 60% year to date. And we are all very familiar with the kind of pain this is causing to economies because of the higher cost of crude oil and other commodity derivatives. Now, the big question you would ask yourself here is what actually happened to cause this? I think the big change has really been the fact that, we've discussed several times in the past about the threat from inflation, and central banks have very aggressively pivoted towards inflation control and to anchoring inflation expectations. And therefore, the US Federal Reserve, which started this year with a Fed funds rate of 0.25%, is expected to actually cross the 3% Fed rate by the end of this year, maybe peaking at somewhere about 3.4, 3.5% in February, March of 23. And it's this large spike in interest rates which has actually started to cause concerns about global growth it has caused concerns about a recession in both Europe as well as US. Europe being even worse hit than US simply because its energy dependence is much higher than the US, which actually is fully self-sufficient in terms of its crude oil requirements. So as a result of this, you've actually got a situation where commodity prices have collapsed, not because of a reduction in the conflict or any peaceful settlement happening in the conflict, but simply because now the central bank focus on inflation means that the market is discounting very aggressive interest rate hikes led by the US, but certainly in economies across the world. And the concern is that these hikes in interest rate could actually cause Europe and US to go into recession, which would then lead to demand destruction in commodities, and that is what has actually caused the sell-off. So I think this is a very strong pivot which has happened, where markets have gone from a focus on war to worries about a potential recession as central banks try to fight inflation. And of course, across the world, central banks are not only hiking rates, they're also pulling back liquidity. Instead of bond buying programs, they now have bond selling programs, and that as well will have its own impact on liquidity. So this is sort of the big pivot that we wanted to sort of lead with today. But we can move on to the next slide now. This is a wrap of the sector performances. I will just highlight two things. Going back about 6 months, you would recollect that the Nifty Small Cap Index was the best performing index. But go to the right side chart, right extreme of this chart, and you will now see that on a 1-year basis, the Nifty 50 is actually the best performing index as of June 30th, and the Nifty Small Cap actually is got a double-digit decline over a 1-year period. Similarly, if you look at the bottom slide, you will see the dramatic shift which has happened in market performance. The Nifty Energy Index remains the best performing part of the market. You saw that in the slide that we saw of commodity prices. But look at Nifty Metal. Even if you go back to May, it was among the best performing indices. But because of the damage which has now happened over a 3-month period, the worst performing index on a 3-month basis is Nifty Metal. This index has now actually slumped to a significant decline over a 1-year period, actually doing worse than the banks, which even otherwise had not been performing very well. So this dramatic change in global sentiment, concerns about a recession coming to the forefront, means that sectors like metal have actually now swung to the worst performing position. And you've also got the Nifty IT, which has been very weak in the year-to-date period, which is negative because remember, the Nifty IT index is a play on IT companies servicing the demand emerging from global multinational corporations. And, the markets have concerns about that demand going into a recession, as well as potential margin pressures for companies because wage pressures are certainly now very visible. And that has caused the IT index as well to sort of, retreat into negative territory on a 1-year basis. So that's sort of, the trends which show up. Coming to the earnings trajectory, yes, very strong earnings expectations for March 22. This is actually showing as estimate, but this is now pretty much in the bag because March 22 is behind us and companies have now started reporting the earnings for the June quarter, and the current estimates are for double-digit earnings growth, 13 to 14% in March 23. If you go to the next slide, this shows the picture of the trend in earnings estimates, and you can see over there the earnings you can see that earnings estimates for March 23. We've also got a trend line for March 24, which is the green line. The dark blue line is March 22 and March 23, and you can see that this line has sort of been flatlining for a while now. It's not shown any movement, and that's the reason why earnings estimates have not really moved much. And I think this is a function of both concerns on growth, right? Because a recession would mean concerns about growth, not in India, but in a global context, and many of the companies would get impacted by that. And also going into the first quarter of the year, the concern was about margins because of those elevated commodity prices that companies were struggling to pass on to consumers. Though I would say that by the time we have come to this current date, because of the sell-off on commodities, maybe the margin pressures are no longer going to be as acute as we were expecting them to be even 1 month ago. And that's perhaps why the estimates have flatlined. But I think you'll see some movement in these estimates once the quarter earnings start getting reported more aggressively. We are still in the early part of the earnings reporting season, only few companies having reported. So if we jump from here now to the valuation slides. Right. So on the left-hand side, Nifty 50 trailing P, now that blue line is gone below the yellow line, which means it's now below the long-term average, and certainly in the fair value territory, fair value being between the red line and the green line. So it is in fair value. In fact, I would say it's now at a discount to the long-term average on trailing earnings. On forward earnings, you are still in the fairly valued territory, slightly above the long-term average. But as the earnings start to come in, you might see this earnings P multiple head closer to the average number. Of course, that will also be a function of how the Nifty behaves. But I think broad message from this slide, in both cases on trailing and forward earnings, valuations are now in the sort of comfort zone of being fairly valued. If you move ahead to the next slide, this shows you the price to book of the Nifty 50 and the return on equity. Now, on the price to book, this multiple still slightly above the long-term average. But keep in mind, when you see the right-hand side of this chart, the Nifty 50 return on equity at 15% is pretty much the best we've had in about 8 years. So yes, price to book trending above average, but then so is ROE trending significantly above average. So in a sense, I think these two indicators are sort of pointing to the improvement in corporate profitability that has happened over the past 2 years. What about the mid cap and small cap? That's on the next slide. Mid caps and small caps, I must say, in valuation territory, still not really as attractive as large caps. The large caps in general exhibiting a lot more value, having come into the comfort zone. Mid caps have entered the comfort zone, small caps barely so. So I would still say that, even though the mid cap and small cap are underperforming the large cap index, in terms of price performance, from a valuation perspective, there is still some bit of discomfort that we would feel more so in small caps as compared to the mid caps. So I think there's still a case to be slightly patient in this context. Moving on from here, how do equities compare to bonds? The long-term yield gap difference between the two is about 1%. Currently, minus 1%, I should say. Currently, the difference is minus 1.6. So even though large caps have come into the comfort zone, if you look at it from the point of view of equities versus bonds, then at this point, I would still say that we haven't yet reached sort of the neutral zone. The argument's still not very favorable in terms of equities. So that's the message from the intermarket comparison. Nothing new to see here. We already looked at the mid-cap, valuations earlier, still at a bit of a premium, and therefore, which is why we said large caps is where we have the maximum comfort. But quickly coming on to the summary slide, this just, wraps up everything that I've talked about so far. There's been a very swift change in narratives where markets have gone from worrying about rate hikes and inflation to the potential risk of a recession in the US and Europe. And as a result of that, you've seen this dramatic sell-off in commodity prices and also in expectations of bond market tightening. So that's point number 2 that you see, that monetary policy still expects further tightening in the US, but the bond markets are actually now starting to price in a reversal in the middle of calendar 23. Commodity prices have dropped sharply in response. And this is slightly good news for India, given that inflation is still outside the comfort zone of the MPC. Not really comfort zone, but the target zone. Remember, the target zone is 4% plus or minus 2%. Currently, we are running above 7%. So we do think India will continue to hike rates, but to the extent commodities have sold off in the last 45 days, it will give a little bit of comfort to the MPC in terms of taking policy decisions. High frequency data, particularly GST collections, indicate healthy growth. With a caveat, GST is a tax on price, and because of inflation, prices are moving higher. So some part of the buoyancy in GST is not volume related, it is inflation related. So the trend is healthy, but we should not overinterpret it simply because there is an inflation component built into GST collections. There is risk to earnings estimates coming from two fronts. One is on account of the risk of a potential global recession, particularly US and Europe, not so much in India, where we think growth will remain positive, and also some risk to earnings estimates on account of the margin volatility that we have seen. Large cap valuations, certainly in the comfort zone, mid and small cap, not yet. Small cap sort of trailing in terms of entering the comfort zone. What does this all mean? When you put it together, aggregate valuations provide a guidance or a framework for asset allocation. And when we combine these indicators, we do find that the pendulum has finally started to shift slightly towards equities. If I go back to October, November of 21, when valuations were much higher, it was certainly pointing away from equity. Today, it has really come back, started the swing back towards neutral, and therefore, from an asset allocation point of view, we take a lot more comfort in terms of looking at equity. When you think about the last, 7 to 8 months or even a year, the Nifty is unchanged over 1 year, but earnings over the last 1 year have gone up by almost about 27, 28%. So in effect, the PE multiple has derated, and in derating, it now starts to give slightly higher degree of comfort to investors, and that should be the reference point for asset allocation. So that's sort of the summary of everything that I wanted to cover on macro and on valuations. And therefore, as before, at this point, I'm going to hand over to my colleague and co-fund manager, Srivatsa, and he'll be talking about the strategies that he manages with value approach. Over to Srivatsa.
Yeah, thanks, Vetri, and a very good evening to all of you. And I thank each one of you for taking your time to attend this webinar. So today I'm going to talk about two funds that I manage. One is the UTI Core Equity Fund and the equity part of the UTI Hybrid Equity Fund. So both are managed pretty much with the same strategy. The only difference being that Core Equity Fund is a large and a mid-cap fund category where I need to have at least 35% in mid-cap. Whereas Hybrid Equity Fund is more or less like a flexi-cap diversified fund where we have kept the mid-cap and the small-cap exposures at around 30%. So to that extent, there is some kind of a difference between the market cap allocations. However, the stocks are almost the same in both the key strategies that I manage. As Vetri said, I largely focus on the value philosophy, more on the relative value philosophy. Now, we look at valuation, or we look at three major parameters. One is a valuation, where we clearly not only look at the absolute valuation, but we also look at valuation more from a historical basis. So we look at a longer term average trending below historical levels, and we look at relative valuations, either with regards to its own history or with regards to the market, or sometimes even global. The second key criteria, I think, which we follow after the valuation criteria is met, is that we try to ensure that the ROCE of the company is greater than the cost of capital. Now, in some of these cases, there could be a case that the ROCE at the current level may be below the cost of capital, could be on account of varied reasons, could be a cyclical stock or some other management related issue. But when we are taking a position in a portfolio, we would want to ensure that in the near future, in a 2-year, 3-year time frame, there is a definite roadmap of the ROCE being greater than the cost of capital. Otherwise, we would not take that stock, however cheap it would be. Just to give an illustration, I would bet on a bank where I may take it at 1.1 time, where my conviction level is high that the ROE of the bank would be 14-15% in the next couple of years. But I would not bet on a bank which is trading at 0.3, 0.4 price to book, where there is no scope of the ROE going beyond 8-9%, however cheap it may be. The third, we typically look at companies which have sound businesses. We try to filter out the companies on the business basis, and corporate governance is a very key parameter. I mean, I would say that's more of a fund house filter that we follow across all the strategies that we manage. So we clearly look at a very disciplined valuation approach. We do believe that each stock has a different valuation cycle, and we try to ensure that we get into the right valuation cycle of good quality stocks. As I said, we look at three broad parameters. One is a relative valuation, which is the preferred metric for quality companies. And here we lay a lot of emphasis on margin of safety. So we clearly look at stocks where there is an adequate margin of safety, because we believe that that is a core to any value strategy, where we buy at valuations where the downside protection is there, where the risk is lower at the time we enter into the stock. The second is the since we have almost 50% of the stocks invested in mid and small cap, the preferred metric, at least on the mid and small cap, specifically more on the small cap, is to look at growth opportunities wherever possible. And especially on the small cap side, we typically look at small caps which are growth oriented small caps available at reasonable valuation. We do believe that there could be enough opportunities, at least in the small cap, or maybe even in the lower end of the mid cap spectrum, where there could be growth opportunities trading at reasonable valuation because of lack of coverage or lack of information. And given a very strong research process and background, we do believe that we can identify decent amount of companies to be included in the portfolio on a growth basis. The third is mean reversion, which is largely exposure to companies in the cyclical industries, either domestic cyclicals or global cyclicals, where we try to either enter in either at the mid cycle or at the bottom of the cycle, and also at valuations which are closer to the bottom of the cycle. Now, here, when we talk of valuations, we look at a range of a metric, not necessarily one particular metric, depending on the nature of the industry. For example, in metals, it could be price to book because the earning typically tends to fluctuate during the cycles. Or in case of real estate, it could be more price to NAV. Or in some other cases, it could be EV to EBITDA, depending on the type of sector and stocks that we are focused in. But the idea is, when we are looking at any cyclical companies, we would want to ensure that we are not catching the company or investing the company at the top of the cycle. We are very focused on investing it at the right part of the cycle where money can be made. In terms of the exclusion filters, the first filter is poor operating cash flows or weak ROCE throughout an entire cycle. Cash flow is a must across the portfolios that we manage. That is a strict big or exclusion factor. The second example which I gave earlier was that we don't look at companies which have a weak ROCE profile throughout an entire cycle, however cheap it may be. The second again is a fund-wide filter that we follow, that any kind of companies with weak corporate governance or poor treatment of minority shareholders is not included in our coverage. And typically, we also tend to avoid companies with debt servicing challenges. While we do look at cyclical companies, but we are also quite wary of ensuring that there are not any big leverage issues, especially in those cyclical companies that we have in the portfolio. Fourth is mature businesses at expensive valuations. So there could be a lot of high PE sectors such as paints or consumer durables. While the valuations may have corrected in relative terms, but Still, we typically tend to avoid those high growth stocks which are trading at very high valuations. And lastly, we also kind of avoid companies that could have significant terminal valuation in terms of the businesses that they are in. Could be in the media sector or in the print sector, where the companies could have some issues on the terminal valuation, where the business is maybe non-existent or significantly reduced over the next 15 to 20 years. Now, coming to the valuation of the fund sector-wise vis-a-vis the benchmark. Now, one, I think, way of figuring out how good we are true to the value strategy is to see what is the average valuation of the fund vis-a-vis the benchmark. And there, both on the price to book as well as on the price to earning basis, we are significantly lower than the benchmark. Even across sectors, like for example, even if you look at a good quality sector like an auto and an auto component or an FMCG or even an healthcare, or valuation both in terms of price to book as well as in the price to earning is significantly lower than the stocks in the benchmark. Also, certain sectors like consumer durables, for example, where we don't have any exposure, where the valuations are much higher than the average sector valuations. Or if I look at the diversified sector, where again the valuations are far higher, we typically tend to avoid these sectors where the valuations are higher. So one way of kind of proving that we stick to our discipline is to see the data, and this data clearly shows that our average valuation for both on a price to earning as well as on the price to book basis is significantly lower than the benchmark. Yeah, next one, please. In terms of where we have moved in the last 1 year, if you look at one of the key bets in the last 6 months that we have taken is in the automobile sector. We do believe that this sector is poised for a turnaround, because whether it is the two-wheelers, whether it is the passenger vehicles, whether it is the commercial vehicles, we are staring at a 5-year or in some cases even at a 10-year low in terms of volumes. Given the recovery that we expect in an economy and given the base that we are sitting on, we do expect very strong cyclical recovery across the sector in the next 12 to 15 months. And the sector also is a big consumer of base metals, which has seen a very sharp fall in the last 3 to 4 months. Combining that, we see possibility of a decent earnings growth in the sector. And the valuations also are very reasonable in the sector vis-a-vis the longer term growth prospects. So we have kind of increased our exposure in the last 6 months in this sector. And this is one of our biggest overweight. Some of the capital goods are also automobile. They are classified as capital goods because the CV as well as the tractors are classified under capital goods, but their fortunes are linked more to the automobile sector. So if I combine that, the weightages are significantly overweight. The other sector that we are overweight on is financial services. There again, if you observe, we have built these positions, overweight position in the last 6 to 9 months. This is another sector where we see a cyclical recovery in the earnings, largely emanating from a fall in the credit cost, because we do believe that the corporate credit cycle has peaked and the average credit cost on the corporate side would be significantly lower in the next couple of years. We also see the credit growth resuming back, and as well as a decent, strong net interest margin environment given the rise in the rates. Combining that with an attractive valuation vis-a-vis the longer term growth, vis-a-vis the longer term trend, makes us go overweight on this sector. And almost 75-80% of the financial services is either in the large or in the very good mid-cap banks that we have an exposure in. We also have exposure in both insurance companies as well as other diversified financial services. The third sector that we are positive on is healthcare, which is both hospital as well as pharmaceuticals. We do believe that the pharmaceutical sector will see some kind of an earnings resilience this year, largely on the fact that we expect some kind of recovery in the US business. And also we believe the domestic growth should start picking up from the next couple of quarters. And also this sector has borne the impact of high raw material prices, which are abating, and valuation for the sector remains quite attractive given the sharp underperformance that we have seen in the last 1 year. Information technology is a sector that we were kind of market weight on, and given the valuation at which it was trading 6 months back, we did trim or weightages. Having said that, I think the sector is looking attractive now, and given the valuation fall that we have seen, we would be kind of looking to have a relook at our positions in the sector. The other two sectors where we are big underweight on, one is metal and mining. I think this is a sector where we were overweight 2 years back at the bottom of the cycle. We have exited some of our positions. In fact, we just have exposure in one metal stock. We do believe that there is risk on the pricing. There is risk on probably even on the global growth, and the valuations still don't reflect. So we would still be cautious on the metal sector. Oil and gas is largely, given the challenges that we are now facing in terms of government intervention in some of these upstream companies. We do believe that this sector would be under pressure, or the multiples of the sector may not move up. Power was something we were kind of overweight on for the last 3 years. However, in the last 6 months, the valuations for the power sector has hit the roof, and we have kind of trimmed our positions here, and we have a kind of a decent underweight position. And the stocks that we have in the portfolio, there is a high level of valuation comfort in both the stocks that we own. Real estate is another sector where we are overweight on. So broadly, if I look at a common theme across the overweight sectors, whether it is automobile, capital goods, real estate, and financial services, we are essentially playing a domestic recovery. We do believe that there would be a decent domestic recovery emanating in the next 12 to 18 months, which is probably not factored in by the markets. And these sectors are very good proxies for that. Coming to the sectors, the we are underweight on is largely global oriented, like oil and gas, or metal and mining, and to some extent even IT. Again, the only sector where we don't have a big exposure is consumer durables, where we are running a big underweight. The reason is that the valuation of this sector is very high. We are still waiting for an opportune moment here. As and when the valuation corrects, we would probably have a relook at this sector. In terms of a portfolio positioning, as I said, financial services is the largest weight in our fund. And we do have a significant amount of financial services companies in the top 10. And as you can see, these are all bank focused, large cap banks where we expect a strong recovery in the earnings. And in terms of the actions that we have taken in the last couple of quarters, I think we have reduced our exposure in the oil and gas and cement. And as I said, we have increased in financials, real estate, automobile, and healthcare. And as I said, we are essentially playing the recovery in the domestic economy, and that's where most of our active weights are positioned. In the small cap space, we are looking at growth oriented sectors and companies. So all our companies, whether it's in the sector of shrimp feed, chemicals, auto ancillaries, pipes, and even infrastructure, these companies are growth oriented. And the other fact I want to also add, that whenever you are looking at a small cap as well as a mid cap, our focus on quality is very high. So we want to ensure that we want to get into a far higher level of quality company, especially in the small cap space, with lower leverage, having a decent ROCE throughout the life cycle, and a good kind of a very good management. That's a criteria on our exposures in both mid and the small cap segment. Yeah, next one. If I look at the performance, I think if broadly, if I look at the value strategy in the last 2 years has done very well, and that's clearly reflected in both the funds outperforming the benchmark on a 2 year time frame. On a 1 year time frame, I think there has been some little bit of underperformance on the UTI core equity fund, largely on account of the mid cap part. I think which we believe will correct. But we do expect to kind of benefit from whatever tilt that we are seeing towards value in the markets, and we do hope to get into a period of a longer term outperformance vis-a-vis the benchmark. Yeah, next one. I think I'm through with this presentation, so I'll hand the floor back to Niranjan for a Q&A.
Yeah, sure. Thanks a lot, Srivatsa, for a detailed overview on UTI Core Equity Fund and the Hybrid Equity Fund. And like we always do, we will now take questions which have come in over the next order. So we have put that on the slide, and we will take as many as possible. So the first question today. This is a question is distributed.
Ranjan, I can't hear you. I don't know whether it's a problem at my end or your end.
Yeah, sure. So
Yeah. So yes.
I think lost you, Srivatsa, for a second. So yeah, this is a question for you. So please.
Yeah. Yes, your analysis is right. I think there has been a strong bout of outperformance from the value-oriented stocks, especially in the last quarters.
Good.
Yeah, so I think probably one of the reasons has been that in the last 2-3 quarters, we have seen high bouts of inflation, and that is impacting a lot of growth-oriented stocks or consumer-facing stocks. And I think there has been some kind of a pull towards stable companies, which probably are insulated from the inflationary impact. So if you look at the outperformance in the last couple of quarters, and one kind of trend that one sees in some of the stocks is that they are relatively insulated from inflation. Either they have pricing power, or they are service oriented companies where inflation isn't high, or they are regulated models where inflation is a pass through. Not necessarily that there is any growth driver contributing to it, but it's more of earnings being more resilient in these companies. And yes, the starting point is also the valuation, which was quite low. It's a combination of these two factors that has led to the outperformance of the value stocks, some of the value stocks in the last couple of quarters.
Yeah. Sure. Thanks for that answer. So there is one question. This is quite because it's like, yeah, this. Yeah. So meanwhile, I think there is one question to take this. So UTI Core Equity Fund as an active overweight position in the portfolio. How do you?
Okay. Yeah, Niranjan, can I answer?
Yes, please.
Yeah. So I think one of the
Yes,
core like philosophy for us is that we do end up taking an active overweight position for most of the stocks in the portfolio. So if I look at the portfolio, bearing one or two large cap stocks, which is there in the top 5 in the benchmark, I think the other 57, 58 stocks have an active overweight position. And that's been one of the core, I think, I mean, that's a common theme across all the portfolios in UTI. And we also have a very high active share consequent to that. Now, in terms of stock weightages, I think one is we also have a fair share of top-down selection in terms of we look at sectors trending at reasonable valuations where we expect some kind of mispricing, and we kind of take active position on the sectors, and then we come on the stocks. So in those cases, the stock weightages are largely based on the index weightages plus whatever active position we would want to take depending on the conviction. These are largely for the stocks which are there in the benchmark, which is roughly around 85 to 90% of the portfolio. The remaining ones which are not there, which is essentially the small caps, here I think we are more measured. We typically don't add more than 1% in the small caps at the time of buying. And we also ensure that the weightages are remained at around 1.25, 1.3% at the max. And we kind of also build positions over a period of time depending on our conviction on the same. So for the stocks which are not there on the benchmark, we typically tend to cap it at around 1, 1.2. These are essentially small cap stocks. And the balance, it's kind of more, the weightages are largely decided on what is the weight in the benchmark. And we take an active position over those respective weightages.
Yeah, sure. So, Vetri, we lost to freight earnings for financial other sectors more at risk.
Yeah, sure. Sorry, I got logged off in between. So I think, when you think about the sources of risk to corporate earnings for FY23, there are actually two different axes of risk, right? So one of them is really the risk to growth. And when we talk about the risk to growth, I think this is dominated particularly, or this is dominant in sectors where the demand or the price at which products sell is determined by the outlook for global demand supply balance. So when you talk about sectors which are heavily export dependent, that could be a cause of concern in those sectors, simply because you would worry that into a potential recession in the US, there could be very weak demand for certain products and services because of the risk of a recession, and this would be true for Europe as well. And remember, China, because of its COVID zero policy, is also an economy which is growing subpar during the current year. Most people only think of China as the world's biggest exporter, but it is also the world's second largest importer. So there are large sections of the world economy which would get impacted if Chinese demand were to slow down, as it likely would into a COVID zero policy, which is what we have already seen. So therefore, as a result of this, one headwind to earnings growth is essentially risk of a potential slowdown in demand. As I said, in India's case, at this point of time, we are not so concerned really about a recession. There could be some minor setback to demand, but nothing as dramatic or on the scale that we are thinking about in other parts of the world. The second challenge is really margins. Now, as far as margins are concerned, remember, this is very, very volatile. I think literally from the first week of February to maybe the second week of March, companies' margin expectations changed very dramatically as they encountered that strong surge in commodity price inflation because of the Russia-Ukraine conflict. But as I mentioned in my opening slides, a lot of those commodity price gains have now been given back. And therefore, while the current quarter's earnings, as well as maybe the earnings for the next quarter, could see some negative impact of those escalated commodity prices and disruption in supply chains, at current prices, I think margins will tend to sort of come back to normalcy by the end of the year. So could it have some damage to earnings? Possibly. But, I think markets will look forward, and to the extent where, margins look to be coming back towards normal, markets will look beyond the damage to a quarter or two. But I think the bigger risk really is from the demand side. I think when you look at it in the Indian context, if I were to look at where the risks are, with rates going up, with some of the issues relating to global demand, issues in China, I think expectations of capex revival would also tend to be a lot more muted. And to the extent that some of those sectors were indicating, or at least expecting, very strong capex recovery and earnings growth from capex, that might prove to be a little bit of a dampener, given the likely increase in rates and the slightly uncertain demand environment that we are faced with. So that's the way I would sort of cut it. There are both tailwinds and headwinds to margins. But largely speaking, the more domestically oriented sectors, even if they face some margin setbacks in the first 2 quarters, look to be better placed. The more globally driven sectors would look to be slightly more vulnerable to some sort of a earnings setback.
Thanks, Vetri. Abhishek Singh. So in the midst of increasingly hostile external environment with multiple headwinds like rising inflation, geopolitical tensions, Fed tightening, FPI outflows, and even soaring crude oil prices, how well is India placed to avoid stagflation risk?
Yeah, interesting question. So actually, I think we have gone well past the stagflation point, remember, because now we are talking about potential recession in the US and in Europe. So actually, we went from rising inflation, strong growth, to a risk of a growth slowdown along with climbing inflation. But that is no longer true. Now we are actually expecting that the economy will slip into recession. So I think the stagflation argument is sort of off the table, and markets have actually moved towards pricing in risk of a recession. I think in the Indian context, you won't get a recession in terms of negative GDP, maybe GDP growth. Anyway, if you look at the sort of sequential growth rates in GDP, RBI's own forecast of 7% GDP growth in FY23, the sequential rates, if you look at it year on year, by the third and fourth quarter, they were estimating that it would be only about 4.5% per annum. So I would say, India never had anyway a extremely strong growth trajectory. The underlying, trajectory or trend line was more like 6%. I don't see too much risk to that number, and therefore we don't really have the makings of, stagflation in that sense in India.
Yeah, sure. So there is another question. So perhaps you can take this again. So in year 2022 so far, the foreign investors have pulled out about $29 billion so from equities, far outstripping the numbers which was seen in the GFC period 2008. So while its relative influence on domestic markets had been lower as compared to other emerging markets, led by strong DI flows in the recent past, what is your prognosis on the ability of DIs to continue with their buying stride? And can the higher US interest dim the appeal of assets in riskier emerging markets?
Yeah, interesting question. I at first just want to pause over here for a minute and just say that, I think at UTI, when we talk about investment process, we think like the owners of companies. Our score alpha investment process is focused on cash flow, It's focused on return on capital, and we have multiple strategies, some which may be more oriented towards high return on capital, high cash flow generating companies, other which are willing to play the cyclicality in those numbers. So when we think of our investment process, we are thinking as business owners for the medium to long term. We don't really look at flows in our investment process. So in our investment process, we never start by asking ourselves the question who's going to buy and who's going to sell, because that is not what the owner of a business asks himself. Of course, we are sensitive to valuations, which is why we always share our thought process in terms of where valuations at an aggregate market level are, but flows are not really part of our investment thesis and our investment process. So I think who will buy and who will sell is really a question which is a distraction from the business of investing, and I would rather not get into it. If you had told somebody 2 years ago or 1 year ago that there would be whatever $30 billion of selling, what will happen to the market, I don't think they would have forecast that the market will be down only about 17-18% from its peak. They would have most probably given you a minus 50% forecast if you had just asked them to draw a correlation. But it hasn't happened, and it hasn't happened because things have changed, markets have evolved. So I think it's a very hypothetical question to ask as to, if not domestic, then who would buy. I think the only point I'll make on domestic is that the trend line of SIP growth, or not SIP growth, but SIP flows has tended to hold up reasonably well. So that gives me some comfort. And I do think global capital flows, money is flowing not just out of India, it's flown out of many countries. When valuations get attractive again, I'm sure you will start to see some of those money flows, start to come in again. So the question we should always ask ourselves as investors is, what's the quality of the business? What's the price that I'm being asked to pay for it? This business of who's buying and who's selling is just a gigantic distraction from the business of investing.
Yeah, well said. Thanks, Vetri. So there are a couple of questions to Srivatsa, so I'll come back to you later. Yeah, so Srivatsa, there's a question to you on the market cap. So considering the current valuations in mid and small cap, so how are you allocating between the market caps in case of UTI Core Equity Fund and UTI Hybrid Equity Fund?
Yeah, so as far as core equity fund is concerned, you may be aware that at least 35% of the fund has to be in mid cap. So we don't have a choice on that. We need to ensure that at any point of time, 35% of the fund is invested in mid cap. And also the benchmark is kind of 50-50 between mid cap and large cap. So here what we have done is we have an allocation of about 37-38% in mid cap and about 10-11% in small cap. Now, small cap, I think the market cap could range from as low as 50-100 crores to all the way down to 12,000 crores. Essentially, what we are looking out for is small caps which could become a potential mid cap in probably 6 months, 1 year down the line, because a lot of migration happens across the three market cap, from mid cap to large cap to mid cap. If you have a fair amount of small caps which are potential mid cap, which is probably a 10-15% away from the cutoff for a mid cap, I think that would kind of save us a lot of portfolio churning and a lot of portfolio disturbances coming out of this classification. The second part is when it comes to small caps, as I said, we typically tend to look at growth oriented stocks. And more importantly, our bar for quality here is far, far higher than say in large caps. And also the weightages in this is, sorry, as I said, capped at around 1.2%, and typically weightages ranges between 50 bips to 1%, which further reduces the kind of risk. So our broader strategy in core equity fund is to ensure that we roughly have around 40, 47, 48% in mid and small cap, and focus is on quality as well as in sizing up of weights to kind of reduce the. Also, I think there is a big discipline on the valuation. So as I've shown you in the table, across the sectors, our valuations are lower. And while the overall valuation for mid and small cap may be higher or could be elevated related to the history, but the dispersion is wide. So you would still find a fair amount of mid and small caps which are trading at reasonable valuation. Coming to hybrid equity, I think our weightages are around 28 to 30%. Because of the nature of the fund, we have kept the large cap at about 70% instead of 50. And the same philosophy applies. So we roughly have around 20 odd percent in mid cap and 10% in small cap. And broadly, the same philosophy applies here as well. The only difference being that the mid cap weightages are lower than the core equity fund, because as per the regulation, that fund needs to have a higher weightages in the mid cap.
Sure. Thanks so much, Srivatsa. So there are a few questions on sectors, which we will take now. So the first one is to you on IT sector. So what are the key concerns in IT sectors, which has led to significant correction over the last 2 quarters? And which are the pockets in the sectors where you are bullish on?
If I look at the IT sector, I think the starting point was the valuation. I mean, 2, 3 quarters back, we've had valuations, especially in the mid cap IT stocks, which were I think one or in some cases even two standard deviation above the longer term history, whether it's 3 years or 5 years. And the second point was the fact that there was some amount of margin pressure which was quite visible, emanating of the fact that they had to increase the salaries because they were not getting the required skill sets. So there was a very sharp increase in the salaries, which was kind of impacting the margin. The second impact on the margin was that there were a fair amount of savings during the COVID period, either on account of travel cost or because of work from home. While still, they have not reverted to the pre-COVID part, but what we also need to assume that the kind of record low expenses that we have been seeing in FY21 may not repeat. There would definitely be an upward bias on that. The second concern of the market is since we are all talking of some kind of a global recession or a high probability of a global recession, whether it will impact the spending or not. I think the jury is not fully out there. We do believe that the earnings, or rather the IT spending cycle, is quite strong. It may continue in the next 3, 4 quarters as well. But margin pressure is here for real. But having said that, I think there has been a fair amount of valuation correction in the last couple of quarters, across the sector. Much more than any kind of earning cut which you can see. So we would be looking at selective large caps as well as certain selective mid and small caps in the portfolio. I mean, we already have in the portfolio, and we have a couple of companies in the radar as well. But that's a broad, but still, I think the mid caps, if I look at some of the mid caps, they are still, the valuations have not corrected. So we would essentially be looking at large caps as far as, increasing our allocation to IT sector is concerned.
Yeah, sure. Thanks, Srivatsa. So, Vetri, this is a question to you coming from Mr. Lokesh Gupta, which is on the crude price. So what do you think about the impact of crude price, especially when China happens to be like buying a lot of crude, which would probably may keep the prices elevated, and how would that affect the crude price, and will it go down anytime soon?
As I said in my opening comments, most commodities have already sold off because of the concerns of global growth, including weak demand from China because of the COVID zero policy. Crude oil has sort of been the one holdout, partly because of the importance of Russia in the global supply chain for crude oil. But I think, if the noises on the recession front were to increase, then it's very hard to see crude oil, not falling victim to that. Whether it will fall all the way back to where it was in January, I have no crystal ball, so I'm not in a position to sort of predict that. But I think it's fair to say that there is a war premium built into the current price, and the risk of a recession is not fully in the price. The risk of any kind of new supply, on account of any settlement with Iran, etc., is not in the price. And therefore, there are many, contradictory factors there which could impact it. So to my mind, crude is not the only issue which is deserves all the attention. The risk of a global recession, the risk of central banks committing a policy error is something that markets are worried about. Crude oil, yes, a bit of a problem, but it's not the only, headwind that markets are facing.
Yeah, sure, Vetri, thanks. Yeah, last few more questions before we wrap up.
Maybe we
One
can take
question
the
on
last two questions. Niranjan.
all right, yeah. So there is one question on IT sector. So Vatsa, you can take this then. So what are the key concern in IT sector which has led to significant correction over the last 2 quarters, and what are the pockets in the sectors where you are
I
bullish
think we
on?
already
Sorry.
covered that, Niranjan.
I'm sorry. Yeah, so there is one question on the pharma. I'm sorry. Uh, yeah, so there is emerging risk from the pharma sector with increasing regulatory clampdowns and legislative changes, which are the likely to expose to the governance fault lines of the companies in the sector. Is there any major risks seen here which may delay the growth, and what are the early signs you look for before investing?
Yeah, if I look at the pharma sector per se, I think the one segment of the pharma sector which is, I would say, derated and underperformed massively in the last probably 5 to 7 years has been the US exports, largely on account of the factors that you mentioned. There has been periodic plant audits, which have kind of resulted in warning letters. So the growth has kind of stopped there. In some cases, I think the problems are serious. So there have been a fall down in the growth. Over and above all this, there has also been a huge amount of pricing pressures in those markets. Now coming to the valuation, I think if you look at companies either which derive their full revenues from the generic markets there, or companies, the large cap diversified companies, deriving a significant amount of the revenues from the US market, they have significantly derated in the last 5 to 6 years because of these concerns. I think there is an increasing realization across companies that there has to be a better capital allocation, and you cannot be investing more and more capital towards a market where the volatility in the earnings is high, and where probably your average ROC is far less than a very profitable domestic franchise that some of these diversified companies have. So in the last, I would say 3 to 4 years, we have seen very good actions by most of the companies who are diversified in kind of stopping their investments in US and focusing more on the domestic markets. And we have seen a fair amount of kind of re-rating. On the US side, I think these challenges will continue, and these have also been hindered by the fact that in the last 2 years, because of the COVID situation, the US planned inspections have been far and few, and though so most of these companies have not been able to get the plans cleared. So this is going to be a volatile business. Having said that, I think given the cycle that we are in, we have seen continuous pricing pressures in the last 3 4 quarters, and now there is an increasing news of most companies wanting to exit some of the products. There could be a cyclical upturn here, but yes, this is one segment which will be under pressure, and that is clearly reflected in the valuation. And also there is an increasing realization across the diversified pharma companies that we need to focus on India and emerging markets, which are the key markets for growth, and these are highly ROCE accretive. So this is going to be a spot of bother, and I think the valuations adequately reflect that.
Sure, Srivatsa. There are a couple of questions coming on banking and financial services sector as well. So if you can briefly cover on this also. So your views on this sectors in terms of the drivers.
Sorry, Niranjan, can you repeat the question on the banking?
Yeah. So what are the drivers of growth in the sector?
As I said, I think one of the driver is that we expect a kind of a decent level of credit growth happening, because of high working capital as well as some of the capex being resumed. There is going to be a decent level of credit growth. The second earnings growth driver would be the fact that, after a cycle of 5 to 6 years, we believe that the corporate credit cycle is very favorably placed. So we would see credit cost, which would be probably 40 50% of what has been the average credit cost in the last 5 6 years, which will further aid in the earnings growth. And also typically in a rising environment, tends to benefit the banks because the rising interest rates gets passed on, whereas there is a lag in passing on the liability cost, because some of them could be fixed, some of them could be kind of sticky. So we do see kind of a reasonable scope of earnings growth in the banking sector. And to top it, I think valuations are still reasonable. They are still in line with the 3-year, 5-year averages. And given the fact that we are headed for growth, there is a scope of the valuations to improve from these levels.
Yeah, sure, Srivatsa. Thanks for that. Maybe, Vetri, you can conclude the session with this question. So, in the current environment of ample availability of information, so what is your advice to investors to distinguish signals from the noise?
Well, I think the most important way to distinguish signal and noise is really to think about events and all of those in the context of how much it actually impacts the long-term performance of a company or a business. And I think we wrote a very interesting piece on this way back in May of 2020 when Ajay Tyagi, who's our head of equity and runs the UTI FlexiCap Fund, wrote a very thoughtful blog where he basically sort of made a very simple case that we did not know, of course, in May 20 how long the pandemic would last or how it would end, but made a very simple case that look, in many companies, even if you wipe out 1 year's of earnings growth, that has only a 5% impact on the value of the business, because the value of the business will be generated over the next 10, 20, 30 years of the lifetime of the company. So I think that's the framework in which we need to think about every business. The business generates its value or gets its value from the cash flows that will be generated over the lifetime. So we spend a lot of our time thinking about small changes in the temperature, small changes in variables, which could affect the earnings for a quarter or two. But in the context of a company, and even let's say the next 10 years of a company's life, 1 quarter's earnings is impacting 1 quarter out of 40 quarters. So it doesn't really move the needle very dramatically. So if there is a way to separate the signal from the noise, I would say that is really the way to separate it, which is to think in terms of the fact that even if I were to incorporate this into my valuation mechanism for the company, how much does it really impact the value of the business when you think of the value of the business as accruing from cash flows over a long-term period. The other thing I would say is, eventually businesses tend to, demonstrate the kind of metrics that they have demonstrated in the past. Of course, there will always be a few companies which deteriorate very significantly, maybe because that business has changed, and there can be some which demonstrate a very significant improvement from the past. But large number of companies, and this is again something that we talk about in Score Alpha, typically the past is a very good guide to the future. And therefore, if you always look at the past data, and if your view of the future is that it is not going to be too dissimilar from the past, you've sort of got to a point where you are being a little bit more even-handed about your decisions. If you are having to imagine a future which is very dramatically different from the past, then automatically you're taking on a degree of risk. Now, that risk could pay off or it may not, but that's a question of how you want to incorporate that particular risk into your portfolio. And eventually, I would say, diversification is one of the great tools that we as fund managers have to sort of make sure that we don't, get confused between what is random occurrences in the market and what is really material to the businesses that we own.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.